Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Our first guest, he's part of the family, Mandeep Singh. He doesn't know it, but we're not going to let him go for 60 minutes because there's so much to talk about when it comes to Deepseek. We want to get into it. As you know, it's the Chinese artificial intelligence startup, Deepseek, their latest model, AI model, sparking a $1 trillion rout in U.S. and European technology stocks. We have been seeing this AI shot play around the globe on this Monday. A lot of questions, though, about maybe valuations here in the United States, but what it really means in the AI race. So let's get to it. Mandeep is Bloomberg Intelligence Senior Tech Industry Analyst. Mandeep Singh, he's here in studio. You've been up early. We've been listening to you, both Tim and I, throughout the day. Why is this all happening? Because for your world, you guys, this has been on your radar. But why is it all of a sudden on our radar, and why should we care or shouldn't we care?
Well, every company has been talking about how CapEx needs to go up because they believe in scaling laws. I think what this development has shown is the hardware that these companies have procured, they weren't using it efficiently. And literally, it's both on the training side as well as the inferencing of the models when it comes to using it in chatbots and so on. And that's where I think you have to ask yourself as an investor, are you ready to pay up for these companies when they are, increasing their CapEx when we know they are not running it efficiently? So I think a lot of questions around just the efficiency of the hardware. I mean, the scaling will continue just because there is more demand to incorporate AI. But the fact that, this model does it so much more efficiently, I think raises a lot of questions.
Does it show that Deepseek is actually ahead of OpenAI, of Anthropic, of Llama at Facebook?
No, in fact, they are using the output of OpenAI and Anthropic and Llama to train their own models. So think about this. Deepseek didn't train this model from scratch the way OpenAI did. They used output from OpenAI's models to train its own model. So in effect, they are paying OpenAI, for all the API calls, but then they didn't have to do things from scratch. And that's where, if you are a Meta Llama who has invested billions of dollars in creating Llama model, what was their incentive to open source it to begin with? Because open sourcing it made it easy for someone like Deepseek to build their own model. And that's the thing about open source is you lose your IP, someone else can come up with a better approach to do things more efficiently, and suddenly everyone runs to them.
Mandeep, is this like the Apple Store? You don't have to be first, you just have to be better? Like I'm thinking about like creating a smartphone.
I won't compare them to Apple yet. I mean, they'll have their problem when it comes to distributing this model. There's no way I can see, Deepseek getting to the adoption of OpenAI, especially here in the US. But at the same time, you have to give them credit for, just being novel in terms of, the limited GPUs they had and how they ended up using them.
Do you trust the information, the research, and do you trust that what they say they did do?
Probably not if they are saying $6 million for training their entire model. I don't trust it because when I look at OpenAI costs for training their, GPT-4 model, it was close to $300 million. Mm-hmm. So we are talking about a 50x gap. Mm-hmm. Now, even if OpenAI wasn't very efficient, I don't buy the 50x gap. So clearly, there is something that they are not counting when they, release the paper. But at the same time, they've given us enough evidence to show that they are doing things much more efficiently on the hardware side because of the constraints they had.
Mandeep, I know you don't cover Nvidia, and we're going to be speaking to Ian King in just a few minutes, who's been covering Nvidia in the chip space for years. But we can't ignore that Nvidia is down close to 18% right now. I mean, it's shed almost a fifth of its value in a just a day. Yes, the run-up over the last couple of years has been immense, but a day like today is just mind-boggling, I think, for a lot of people. Should Nvidia, in your view, be worried?
I mean, look, that's where a lot of the questions come, is the cost for training the next model. So if Deepseek is saying that the cost was $6 million, I think Nvidia should be really worried. But a lot of people are apprehensive of that 6 million number because they think it'll be higher. And it won't be 300 million the way OpenAI's was, but it will be higher. And that's where I think OpenAI or Anthropic will have a very tough time selling to their investors that they need to build a 1 million GPU cluster to train the next version of their model.
Mandeep, does this show that even though the U.S. has been pretty rough in terms of restricting advanced technology going over to China, does this show that Chinese R&D and Chinese companies can be pretty scrappy and pretty smart and maybe figuring a go around and coming up with their own way of competing against Nvidia and the like?
Yeah, and look, I think this could be another way of them saying, look, we are open sourcing whatever we have learned so far. So they want to build a community because the export restrictions aren't going away.
Yeah.
So they are not going to get the Blackwell chips on paper and all the other allocation. And the thing about model training is it's continuous. It's not a one and done thing. So you have to continuously improve your model. The other labs will go ahead if they're not able to, keep doing the training and all the other stuff that other labs are doing. So from that perspective, I think the whole aspect of community building is front and center here.
Yeah.
But I still think the cost parity is a very big concept here.
Hey, before we let you go, Mandeep,
Yeah.
you do cover Meta Platforms. The company out on Friday, Mark Zuckerberg saying he was going to be spending more on CapEx than previously announced. Then the stock moved higher on Friday. Stock was lower earlier in the session, but higher now. I mean, I look at a move like that today, and that runs counterintuitive to kind of everything we're talking about.
Look, there is a lot of confusion, but if there's one thing that happened today is this moment is good for open source. And Meta Llama is an open source model. So if anything, open source does get a nod when it comes to, what Deepseek is touting here.
But you do also think about if it's cheaper for companies to build out, then does everybody have to rely on some of the bigger players? Maybe not.
Next time, Meta Llama will collect a fee from Deepseek for using their model to train their own model. So that could be a positive.
Love this world that keeps us on our toes. Mandeep Singh keeps us though on the straight and narrow. He's Bloomberg Intelligence senior tech industry analyst here and has been all over this story. We want to focus a little bit more on semiconductors because we have seen that group really taking a beating. You've got almost all 30 names, 28 out of 30 down in the Philadelphia Semiconductor Index, down about 10%, the index as a whole. Nvidia is down 17%. So ouch. What does this mean for Nvidia specifically? We get to now Bloomberg News U.S. semiconductor and networking reporter Ian King. He's out there in San Francisco. I don't know, Ian, how we've all been talking about this nonstop today. You're the expert. How are you thinking about Nvidia and possible impact, the reality of it all? How do you see it?
Yeah, I mean, a lot depends upon how much reality there actually is behind this claim, behind, it was a very well set out, well referenced research paper at this point, and the model has been open sourced, and we'll see what people can do with it. The implication is, of course, that things got cheaper, things got more simple. But we'll have to see that manifest itself in the real world. And then obviously you can absolutely bet that Nvidia and a lot of other computer scientists at some of the most powerful companies in the world are looking at this right now, working on this. For some of them, this would be great news. For others, it would be a disaster. So they'll be definitely testing out the veracity of this. And I think the actual where the truth lies will emerge with a bit more time.
Ian, what do you make of sell-offs in other names today? Broadcom, for example, Marvell. I mean, everybody is getting hit in the sector, as Carol mentioned. 28 of 30 names lower.
I mean, the logic is absolutely clear, right? I mean, if you are no longer a believer in this exponential growth in spending, in this exponential need for more and more computing, then you're going to sell Micron, you're going to sell Broadcom, you're going to sell Marvell, and of course you're going to sell Nvidia. All the logic based upon an assumption, and that's what it is at this point, is flawless. I mean, for example, Broadcom, they are the key ingredient in terms of these companies like Google that are now designing their own chips for this type of purpose. So if there's going to be less need for that kind of high-end chip, then it makes sense to sell them.
I mean, none of this happens in a vacuum, right? So I can only imagine the meetings that are happening at Nvidia today and all of the chip companies. So would you expect them to, take tear apart the research from this company and try to understand exactly what they did and then come back with their own response?
They've got to do that, right? I mean, if this was a 2 or 3% move and a few market jitters, then you probably as a management team, you look into it fiercely, but you just keep your mouth shut. But we're just about to go into earnings season, right? So whether they like it or not, for example, Intel on Thursday are trying to get into this market. They're going to get asked about this. What have you got? How can you deal with this? Is this good for you? These are all questions that I think everybody's companies are going to be answering over the next 2 or 3 weeks, and they better have some good answers.
Ian, do folks you speak to who are covering the industry, have they been waiting for a day like today? Like, was this bound to happen?
Investors do two things, right? You have different types of investors, but basic pattern recognition is supposed to be the skill that everybody can bring to this, whether you're technical or whether you're just a general investor. So I think a lot of the general investors will be like, let's not be on the wrong side of what happened in 2000 with all of the internet sell-off. Let's get out right now, right? Maybe we're at the peak. More sort of technically savvy investors will probably take their time, look at this, and try to find out just how much truth there is there and just how many concrete implications there are.
Well, in terms of implications too, a lot of what's been kicked around throughout the day is, I feel like TikTok, version 2.0. In other words, another Chinese company, you want to know how much the government is involved and how much maybe, did they support the R&D? CFIUS from the United States, the Committee on Foreign Investment in the United States, are they going to weigh in on this, whether or not, American companies or, can tap into it? I mean, it's a whole other round of this, it seems.
And clearly there's a lot of scrambling going on, and the path that's happened so far in that particular area has been to restrict access to these high-end chips. So guess what? The country that is restricted from these high-end chips suddenly comes up with a magic bullet solution, which says maybe we don't need as many of these high-end chips, or maybe we don't need them at all. So there is an element of like, okay, is this the answer that they want us to be concerned about, or is this really the answer, or have we given them so much incentive to find a way around it that they've poured all their energy into it, been really smart and got around it? I mean, layers upon layers of things going on here. But in general, there are no magic bullets in at least the chip industry. It tends to be a pretty incremental industry where we see changes over time. Software can be more volatile and is prone to more kind of instant changes in thinking. But even then, the change to a whole industry, the direction it's going in, it's a little bit hard to imagine that one morning we all wake up and go, oh dear, right? But at the same time, if you're an investor, you can't afford to ignore the possibility. And if you're the CEO of Nvidia or the board of Nvidia or the senior management of Nvidia, you cannot afford to ignore the possibility.
Ian, on a day like today, we're certainly focused on the big names that are moving lower by double digits. Nvidia certainly down. Broadcom is lower today. Oracle's down by 14%. But from a hardware perspective and from Deepseek's perspective, what do you know about the hardware that Deepseek uses to train its models?
And that's a very good question. That's probably one that the US government are looking into, which is, some of the analysis that we've seen has been like, look, yes, this model that they're citing, but it's actually a derivative of another model. How did they train that original model? So should we classify this derivative model that they're offering up as part of this larger equation, which they must have developed with Western technology? And the simple answer is we do not know, and there's going to be a lot of pressure on those that need to know and should know to find that out. And I think we're going to see a lot of reporting emerge. We're going to see the government looking into this to find out What did they have access to? Should they have had access to it? If what they had access to was in fact more efficient computing than what, say, Microsoft is putting in place, then wow, here we go, right? This is a breakthrough. So many layers to this onion, and that's not a very useful conclusion, but I think it's the best that we can offer at this particular point.
A lot of questions still out there. Ian, thank you so much. So appreciated. Of course, our Bloomberg News U.S. Semiconductor and Networking reporter.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Feels like the last week or so, topped off by today's news on Deepseek, has put the AI story once again, Tim, front and center in a super big way.
Yeah, remember just last week, President Trump and a group of tech companies, SoftBank, Oracle, and OpenAI, initially planning to invest $100 billion to build U.S.-based infrastructure, including data centers for OpenAI, the project we know called Stargate. On that, though, one very high-profile tech and administration voice who's not all in on it. It's something that Bloomberg Businessweek columnist Max Chafkin gets into in his latest story and in the latest Bloomberg Businessweek daily newsletter. You can read Max's Businessweek story on the Bloomberg and at bloomberg.com/businessweek. Max, the co-host of the Elon Inc. podcast, also the author of The Contrarian, Peter Thiel and Silicon Valley's Pursuit of Power. Max, we're going to talk about Elon, Stargate in just a second, but Deepseek is where I want to start because it's what's hitting the tech names today. Well, I don't want to say all tech names. It's what's hitting, Nvidia, Broadcom, and some of the other chip names in a big way today. How are you looking at it?
Absolutely. Well, as you're hinting at with this discussion of Stargate, until basically this weekend, AI infrastructure was seen as the end-all, be-all. They were talking about not 100 billion, 500 billion, right? And at times, Sam Altman has said he's gonna need $7 trillion in funding for AI infrastructure. And there's been this sense, especially among Google, OpenAI, a bunch of these big players, that this is going to be the thing that only hyperscalers are going to be able to compete in, that whoever has the most infrastructure, even whoever has the most power, right? We've seen a big run up in nuclear stocks and things like that. So, and this sort of threw all that out the window, because if we're to believe what Deepseek is saying, this was done with a much, much lighter weight, amount of usage of chips, and it actually is running a lot more efficiently. So that suggests, right, that this crazy run up we've seen in demand for GPUs and so on might be overheated. Now, we had other reasons to think that there was perhaps some sort of bubble or a little bit of frothiness in this market. And I do think if it hadn't been this, it might have been something else, right? I think investors were and are primed to see to see potential flaws and with the business model that so many have bought into.
So not necessarily an end of the AI spend, but just kind of a twist and turn in the story. And there's still more to be known, right, Max, in terms of the reliability of the information we're hearing from them and the reality of it.
Yeah, there's so much we don't know here. And again, it's definitely worth, I think, approaching Deepseek's claims skeptically, and also understanding that if they were able to develop a much more inexpensive model that could help parts of the AI market, it doesn't necessarily mean that all of this goes away or something, but it
maybe
does
make it more accessible, right?
Exactly.
If it's less expensive.
Yeah, but it could cause investors to dramatically revalue some of their assumptions.
How does it change the narrative around what China is able to do when it comes to AI right now, and sort of the tech race that's happening there?
The thing is,
because they weren't supposed, these chips, a lot of these chips are not supposed to go to certain parts of the world.
Right. So there's something potentially troubling there if you're looking at the attempts to restrict certain U.S. technology to China. It seems like either those restrictions aren't working that well, maybe some GPUs found their way to China, or that the Chinese software industry has found ways around it, which would also be potentially problematic, I suppose, from a sort of U.S. national security perspective, at least from the point of view of the China hawks who have been sort of warning about this, and that includes many of the Silicon Valley companies. Remember, one of the big reasons to justify this massive spend on AI, and one of the reasons that many of these folks, including Sam Altman, sees this as a thing that government should be involved in, is because they have been arguing that without this, without spending huge sums of money on, say, on power or investing in infrastructure in terms of data centers, that we would fall behind the Chinese tech startups. And that may, you know, if you sort of extrapolate from this very small piece of news, you might say, okay, well, it's happening anyway. So that sort of throws everything into a bit of disarray.
All right, so let's get to Stargate. Love the name. Elon Musk. I find it interesting. I think we all found it interesting that here's this big announcement, right, that comes out of the Trump administration last week, and Elon not so in on it, is he?
No, not in on it at all. You know, it wouldn't be surprising if you had this big announcement with Donald Trump and the CEOs of some major companies talking about huge numbers, right? They were saying we're going to invest $100 billion immediately, $500 billion within the next 4 years. Would not have been surprising if some people said this sounds like a political stunt. I'll believe it when I see it. It's just what made this thing that happened last week so surprising is that the person saying that was a senior advisor to Donald Trump. And it was Elon Musk tweeting over and over and over again last week. I mean, the last time I checked 20 times, he's tweeted a few more times, you know, the usual mix of, I'd say, off-color jokes and put-downs. You know, he's called Sam Altman, who was, of course, on stage with Donald Trump, a swindler. He suggested the announcement was fake. And Trump has sort of responded by saying, hey, you know, Elon Musk has a dispute with one of the people in this deal, which is true. Sam Altman and Elon Musk have been feuding more or less in public for the last couple of years. So we're sort of seeing, I'd say, you know, maybe one of the downsides to having somebody who is as deep in the business world also involved as a advisor to the president.
I mean, is Elon Musk at this point saying, hey, I gave you some giant bags of money to help you win the election? And
what were you thinking?
And now you're doing this. Does this risk driving a wedge between the two of them?
I think for both Musk and Trump, I mean, there has been, over the last couple of months, people have been on high alert for signs that this relationship might be breaking up. And I would say that it doesn't seem like this has done it either. You know, Trump has cracked jokes before. We've seen these tweets. There was a dispute over the H-1B visa thing. Mm-hmm. Both Musk and
maybe
Trump,
that led to the divorce between Ramaswamy and Musk.
Yeah, at least according to some reports. You know, it's possible there are other reasons as well. But what I'll say is, it seems like Musk and Trump are still working closely together. I'd say Trump's comments about this, to me, suggested that he was untroubled by Musk's, apparently kind of trying to undermine or undermine some of his partners in this deal. And I'd say part of that is that, you know, there's not necessarily government money going into this in the Stargate thing. It really was basically a media event for Donald Trump to announce a big business deal so that he can claim credit for helping to spur the economy. It's kind of like a vibes thing. And I think because of that, I'm not sure it really hurts Trump all that much to see Elon Musk dissing Sam Altman on Twitter.
Well, you write in your story, Max, you said Musk has always treated his conflicts of interest like features rather than bugs, seeming to run his normally independent companies with their nominally independent shareholder bases as if they were a single conglomerate. You talk about employees being lent out, sharing of resources and stuff. So conflict, he's kind of all in on this too.
Well, yeah, absolutely. This is a big part of, first of all, competing in this area is a big part of Elon Musk's big plan for his companies. Not just Tesla, which of course is developing advanced robotics and is trying to build self-driving cars, but also XAI, his chatbot competitor. So he is very much playing in this market. He is also competing to buy these Nvidia, these high-end Nvidia GPUs. He's building giant data centers. So he very much has a dog in this fight, and that's why he's doing this. And I think Trump's attitude seems to be, that's all out in the open, as long as people understand that what's behind this is a business dispute. Again, he said, well, one of the things is he hates one of the guys in the deal, an obvious reference to Elon suing Sam Altman.
He said that too.
But then Trump said, I hate people too. So
we all have a problem child.
But I do wonder, what Donald Trump has been able to do in recent months has been pretty incredible when it comes to the tech industry. I mean, a week ago, Carol and I were sitting here looking at the stage during the inauguration, and you saw titans of industry who were not at previous inaugurations there, all collectively getting behind the president. I mean, he is this larger than life figure who perhaps can bring people together who don't like each other, maybe because he offers them something that they want.
Yeah, well, Trump, probably more so at least than former President Biden, approaches the presidency in a way that I think it would be fair to describe as a little bit more transactional, right? He's willing to bend his policies to make deals. It's the whole thing that he's about. And in certain ways, right, that works well for CEOs. I also think there's a lot going on there. There was a lot of built-up anger in Silicon Valley over some of Biden's policies, over antitrust, for instance, and you have a lot of opportunity right now. There's a sense that they have leverage because by showing up in these Trump things, they're giving Trump some additional credibility, and they're trying to use that to get what they can, which is favorable policies, favorable antitrust policies.
We're going to talk about that in the next couple of hours.
Hey, Max, I do want to go back to where we started and Deepseek, because we're getting some breaking news. Nvidia is out saying that Deepseek is, quote, excellent AI advancement, and says that Deepseek's work, quote, fully export control compliant, and says that inference requires significant numbers of its GPUs. This is in an email statement on the Deepseek AI model. They're coming out and saying or talking about it. I'm wondering how you view that.
I mean, I think it's, first of all, everybody's talking about it. It seems like they have to, and they also, I think, in that statement, again, I haven't looked at it, I'm just hearing it now. It seems like an attempt to address suggestions that perhaps Deepseek had access to improper access to GPUs or something like that. Sounds like they are saying that, no, that's not the case. Again, it definitely seems like this would be a business challenge for Nvidia if you were able to do the kinds of chatbot work much more efficiently with about the same sort of level of quality. That's going to make these GPUs perhaps not as valuable. But again, there's a lot here that we don't know. And you also have seen people on the other side of this saying, actually, this is going to be great because it's going to make these chatbots so much cheaper. We're going to see tons of them. Essentially, we're going to make it up on volume. It's hard to know how to evaluate that when we don't know that much about how this was put together or really just how good the quality looks. People have been playing with it only for a short amount of time.
Wait, you want details? Silly you. Great stuff. Max, thank you so much. Bloomberg Businessweek columnist Max Chafkin. He's also co-host of the Elon Inc. podcast. You can check that out. It's on the Bloomberg and also at Bloomberg.com/Elon Inc. Max is also author of The Contrarian, Peter Thiel, and Silicon Valley's Pursuit of Power.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hey, I guess reading in this morning, Morgan Stanley continues to recommend that investors hold long 5-year treasuries ahead of two potentially dovish market catalysts. And those catalysts are the January Fed meeting, so not this week's meeting, and then this month's job report. Meantime, you've got JP Morgan staying along the front end of the treasury curve, while BMO positioning for 2 quarter-point Fed cuts this year. So while we are focused so much, Tim, on tech and AI news this morning, let's not forget we get the first Fed decision of 2025, that decision out on Wednesday.
Okay, with more on that in the studio, we got Ian Wyatt, Senior Vice President and Director of Economics at Huntington Commercial Bank. It's a division of the publicly held, roughly $25 billion market cap Huntington Bank shares. Ian, good to see you. Look, before we jump into exactly what we're going to hear from Fed Chair Jay Powell, I would imagine he might get some questions around AI and the market sell-off this week. Whether or not he answers those questions, that certainly remains to be seen. I would figure out a way to ask him a question around that. How are you looking at what's happening in the market this week, especially ahead of this Fed meeting?
I think, first, in terms of the Fed meeting, not related to AI, I think our view is that there's still inflationary pressures out there in the economy. But I think it's really, we have this 2-speed labor market we're seeing. We're seeing is for lower end jobs, where's the job growth been? It's been restaurants, it's been hotels, it's been a lot of service areas. And when I talk to companies in those areas, whether you're manufacturing, transportation, still a tight labor market. They're having a hard time finding workers. If you're talking about more of a college job, professional and business services, where are we not getting job growth? IT obviously has been down. We've seen, them focusing on cash flow more than job growth. So we kind of have this 2-speed labor market where you still have a tight lower end. And the problem for inflation is a lot of those industries are very labor intensive. Childcare, for example. It's something where labor, or restaurants, labor makes up a huge percentage of your cost structure, and they're still feeling that pressure. So I think we've probably been on the low end of the Fed saying in terms of cuts for 12 months now.
Yeah.
Now I think we're more in line with the 2 cuts roughly this year. But I still think that pause holds for a while because I think there is that fundamental underlying inflationary pressure. That is not really, when you tease out inflation, you look category by category. It's not been durable goods. Durable goods have been coming down, but it's also stuff that consumers can choose not to buy.
So Ian, I just want to stay with AI for a moment. That AI spend, the economic activity it may impact on the up or downside. How does it, if at all, factor into any of your economic models when it comes to growth, when it comes to inflation, and then ultimately to Fed policy?
AI caused me to get one call really wrong last year. I thought construction employment was going to come down.
Yeah.
I thought, multifamilies coming down. We saw warehouse space is oversupplied now. Obviously, office has its issues. And I underestimated how much it would be CHIPS Act. It would be the chip plants like Columbus, for example, where we're headquartered. They have that massive Intel plant, a couple of the largest cranes in the world operating there. And AI was a huge part of this. And I still think there's this huge first mover advantage. You don't want to be the last company. You want to be the last company that still gets a power connection versus the first where they say, no, we don't have enough juice. We can't afford, or we can't build, connect you for 5 years. And I think that case still remains.
Yeah.
I also think there's another bullish case for power that when you look at the forecast isn't really baked in very well.
What is that?
Well, transportation.
How so?
So, okay. If you look at U.S. energy consumption, roughly 15% of U.S. energy consumption is residential. That's what we always think of our power. 37% of U.S. energy consumption is transportation. Right now, over the last 6 months, roughly 10% of U.S. car sales have been plug-in vehicles. Now, vehicle fleet takes a long time to turn over in the U.S. Average vehicle age is over 12 years now. It takes a while, but as that starts to kick in, if you even get a small fraction of that 37% shifting from fossil fuels to electric power, it doesn't really matter the source, whether it's gas or solar or whatever, you have a very different outlook for electric demand at the U.S. And I think that also means utilities are going to have to build a ton of infrastructure.
Does that get derailed by the Trump administration pushing back against EV subsidies and trying to get people to move away from EVs?
I mean, I think it slows it to some degree. I think that's definitely, you're seeing a shift in administration policy. If you look at Germany, for example, when they cut their EV subsidies, that dramatically slowed EV sales. But it's still something where there's a lot of the global market is shifting in that direction. Autos are shifting that way.
China's all in.
China's all in. I mean, you talk to a friend of mine runs FedEx distribution, owns a couple FedEx distribution places, and he talks about, the gas prices on his delivery trucks. And he's really looking, how do I lower my fuel expenses? And that's really a perfect application for EVs, short range, stop-start driving.
So does he do that with Rivians? Like what Amazon is doing?
Yeah, I mean, he's looking at
able
those.
To do that?
Yeah, he's looking. I mean, Rivian's just starting to sell beyond Amazon now. They're just moving beyond Amazon and filling those initial orders. Whether it's that or Ford and Stellantis both have products in that market as well.
Sorry, Carol, I know we were supposed to be talking about the Fed.
I kind of love this because it's a fuller picture of kind of the markets and really our economy. So having said that, I mean, I don't know, this January meeting, the decision on Wednesday, Ian, is it kind of a snoozer because we don't really expect anything? Or is there a fine needle that Jay Powell has to thread here in some way?
I think thematically we've seen, a year ago when he did the Powell pivot, you felt like there was pushback right after he spoke at that presser, and it definitely seemed like he was on the dovish end of the spectrum. If you look back at the September vote on the dot plot, you can see almost half of Fed governors only wanted 3 cuts this fall. So that would mean essentially there should have been 125 in each meeting. And that meant they were opposed to 50 in September. Now, obviously, they all get on board. They all push in the same direction. But if you look at the minutes, you look at the notes, I think he's still, again, I think this is a repeat of about a year ago. He's on the dovish end of the spectrum. He has to get the board to come along with him. And I don't think I think the inflationary pressure is still there. I still think there's some underlying, and when I talk to companies in the economy, depending on the part of the labor market they're in, It's still there. It's still significant. And I think that helps some of the more hawkish voices on the Fed. We're the very narrowly balanced Fed, I think, on this.
So it's really labor costs that you're most concerned about. It's not the price of eggs that everybody keeps talking about. It's really labor costs.
Well, yeah, I mean, I'm the grocery shopper in the family, so I definitely notice the price of eggs. And I used to work in Georgia, so I know, top egg economy, top egg producing state in the country is basically offline right now because of bird flu.
Right.
So there's some big things going on there. But no, I'm much more concerned about rent growth. I mean, that's a good sign we're seeing on the inflationary front. If you look at the market-based rent indexes, you can see you're at 1.5%. The problem is, 2/3 of Americans own their home. A lot of that's single family.
Yeah.
We're still seeing, and the implicit rent deflator from that comes from rents on single family, not multifamily, and that's still feeling pressure.
What did you want to say? I know I jumped in on you.
Oh, I wanted to just say Nvidia's down 18%.
Nvidia's down 18%.
I want to remind everybody that's the data we're looking at. Broadcom's down 18%. Oracle's down 17%.
Yeah.
Alphabet down 4%.
No inflation there, right?
Yeah, that's the backdrop of today's
Some would
Fed
say it's on
conversation.
sale, or maybe not, depending on the outlook. This was really fun. Come back soon.
Thank
Ian
you.
Wyatt,
Appreciate it.
Senior Vice President and Director of Economics. Loved where the economic conversation went over at Huntington Commercial Bank, joining us here, Tim, in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Suzanne Dann is CEO of Americas over at Wipro. It's a global consulting firm that provides services related to IT, cloud, and yes, AI. And that's really what we want to talk to her about, because that is why we're seeing the sell-off. Concern that a cheaper AI model from the Chinese startup Deepseek could make valuations of these tech that has powered the bull market pretty tough to justify. It's what we spoke to Gina Martin Adams about just a minute ago. Suzanne joins us from East Brunswick, New Jersey. Suzanne, you are just back from Davos, where we know AI was front and center. Given comments that we heard from Alexander Wang, who's the founder and CEO over at Scale AI, how would you, though, characterize the AI conversation that was happening over at Davos?
Well, thank you both for having me. Everything was AI last week. You could walk down the street and every storefront had something about AI or was talking about AI. So it was front and center. This is clearly a defining year for AI and for Gen AI. And businesses are looking to figure out how do they drive value from this. Most CEOs believe that it's going to significantly change the way they do business in terms of how they create and deliver value and obtain value from the work that they do. And there was a clear momentum around, defining the strategy in which they're going to invest in AI to create that value.
Why do you think it's that they were saying, or why is it that this is going to be a defining year? Especially on a day when we kind of just got, a company that might say, hey, you don't need to do the big spend, or, we can do it. It's a different, maybe financial model in terms of the build out. I feel like we're still kind of finding our way. So why is it that 2025 is the defining way? I'm not quite sure how to read that.
Well, I think last year everybody was talking about AI and just piloting with Gen AI. It was, it's democratized. Everybody has access to it. We can use it. I think the Gen AI race is entering a new phase. We saw it this morning. And I think we're still in the beginning. To me, it really calls to everyone that this emphasizes the pace we're going to see innovation, and really figuring out how we can create agile environments to deliver on AI. And at the end of the day, it's going to be about the quality of the data that these AI are trained on and deliver for our clients to really deliver value to the organizations, regardless of how much they spend. And I think where we see it is our clients really are talking about the data they need to fuel AI, whether it's a large language model or a small one.
Can you just for context, because we do speak to a lot of folks who run consulting firms or run parts of consulting firms, just give us an idea of your clients, the type of clients you have, and who's out there working with you.
Yeah, so my responsibility, I have clients across financial services, oil and gas, energy and utilities, high tech, and manufacturing and automotive. So I have clients across many different industries and many different challenges that can be solved with and without AI.
So who would you say is leveraging AI the best right now?
Well, AI is it's been around for 10 years. We've been using it in AI. And many of our financial services clients have been using AI and machine learning models for years. It's only now with Gen AI we're seeing this acceleration. And that's what's truly exciting, is how we can leverage the Gen AI applications. We've been also leveraging it internally so that we can learn and then deliver those learnings to our clients. We're leveraging in HR, we're leveraging it in legal, across the board, to make sure that we understand how AI can be used and understand the foundation and the governance and responsible nature in which we need to deploy it and train our people to make sure that it's successful.
So, Suzanne, what I'm wondering is, like, on a day like today, where this story, a company that nobody had really, or I shouldn't say nobody, because our Bloomberg intelligence team's like, yeah, our team overseas has been writing about Deepseek for, the last couple of years. So it's not necessarily new to them, but it's certainly new to, I feel like, our conversations when it comes to AI in general. So I am curious, have you guys, your team, your phone's been ringing today to say, wait, what is this Deepseek? And, I've been spending X on my AI infrastructure build, or, making plans. Do I need to rethink it? Do I not need to spend as much, on site versus not? Tell us about today and the conversations perhaps that you guys have all been having.
So today it's all over the news. It's absolutely correct. Everyone's talking about it. I think the reality is, over time, there's going to be winners and losers. The role that we play is helping our clients make sure they have the foundations in place. One of the biggest, and I'll go back to it, is the data and the people. Training your teams to think about AI first and how to bring AI into a business to add value, so it could make agents that could make autonomous decisions and be managed appropriately. The data foundation, so the models don't hallucinate. All that has to be done regardless of the technology that you choose. So that's where I think the real, area that we can add value in helping our clients navigate both the frameworks, the governance, the training of the people, all the change management and the data, all that still has to happen, regardless of which model that you choose to use and the foundations you build on.
So the spend is going to still happen? Nobody's going to pull back? Yeah.
I think it'll depend on what the use case is and what the spend will be. So I think that is yet to be determined, depending on the models that our clients use. And many of our clients are using large models, and many of our clients are using their data and developing small models. But, I do think this is a race that is continuing, and we're going to see this evolution and many more to come.
Where do you see the actual money savings happening with these companies that you work with? Is it from a customer service perspective, the whole rise of the AI agent? Where will their margins be helped?
Yeah, so I think there's two things. There's the whole side of productivity and efficiency. And we're seeing that in development, making our developers more productive and more efficient. And we're seeing it in testing of technology and applications. Absolutely. We're seeing that today. There's also things like contact center, where we're helping clients in servicing and using AI to make the agents smarter and delivering higher quality engagement. So there's lots of area where we're seeing productivity and efficiency. And the question is, does that translate into our clients being able to add more higher value work to those, or driving the costs down in their business? And we're seeing both. We launched, just as one example is Wipro Now, which is a HR intelligent agent. And we put all of our HR policies and procedures into this agent. And it's serviced over 8 million queries to date at greater than 90% accuracy. We've been able to reduce the number of HR employees to service those queries and to service those and be able to repurpose. So you can say that's a great efficiency play, but it's also a great employee experience. Our employees are able to get real-time information, real-time insights into HR, and be able to have a better experience than maybe looking for documents in lots of file folders.
Well, that's what I wanted to ask you. What was the kind of satisfaction rate? As I play around, or increasingly I'm, working with chatbots to deal with customer service issues. I mean, sometimes it's really great and sometimes it's not. So I'm curious, from your internal team, how did it go? Or what you guys have learned in the process, because it's never perfect right out of the gate.
No, it isn't, and it takes time. In the early days, the quality wasn't as good as it is today, and the satisfaction is really high. I don't have the specific numbers. I know I've used it, and it has been great. The reality is, it's not the chat bots, which is based on rules. It's an intelligent agent, so it learns over time, and we all know that's the power of AI, and that's what makes it a great experience. So when something needs to be adjusted, it can be. And when there's feedback, it constantly is iterating. So it's only getting better over time and becoming the most intelligent HR agent it can be. So I think overall it's the right direction in terms of creating a great employee experience and enabling HR to do what they should be doing and taking care of people and not just answering simple questions. And I think that makes it for a more interesting HR experience for that employee as well.
What about the administration and the role of the Trump administration in this? We saw the announcement of Stargate last week, $100 billion up to $500 billion of investment from AI companies. What was the conversation happening around this administration with regard to AI?
I'll tell you, at Davos, there was optimism around the global economy and the resilience, as well as the U.S. economy. And overall, there was interest around what we're doing around AI, as well as regulatory policies. And I think overall, there was really just great optimism in Davos around the U.S. economy.
So in terms of kind of where we go from here, you're in it, you guys are doing it at your own company, you're working with companies consulting when it comes to AI. This is year number 3, right? That this continues certainly to be an investment theme, although taking a big hit in today's session, no doubt about it. So top of mind that you think investors should be watching out for, and just got about 30, 40 seconds here.
Yeah, I see the investment in AI to continue, and I think the speculations is going to double in the next couple of years. I don't believe that has changed. Our clients are investing in AI, and I think today's announcements and what we saw today only emphasizes the importance of innovation moving at pace. And I really do believe it shows that those who invest now in bringing AI into and learning and experimenting and scaling will be the market leaders. It's going to disrupt every industry. And that's what we're encouraging our clients to do, to lean in and, power their organizations with AI. And that's why we've added, Wipro powered AI. And we really believe us being powered by AI will only help our clients be successful in implementing in their own business.
Suzanne Dann, CEO of Americas over at the global consulting firm Wipro, joining us from New Jersey this afternoon.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, got about 18 minutes left in the Monday trade. You are listening and watching Bloomberg Businessweek. Carol Massar along with Tim Stenovec live here in our Bloomberg Interactive Broker studio. You heard Charlie and Bill Maloney breaking it down. S&P down about 1.7%. The NASDAQ 100 down the most when it comes to the index trade. We're looking at about 3.2% decline here. I am curious to see what Aaron Kennon has to say about all of this. Co-founder and CEO at Clear Harbor Asset Management. They've got about $1.5 billion in assets under management. Joining us once again from Stamford, Connecticut. Aaron, the story that we're all talking about, Deepseek. I am curious. I know. We're trying to put it into context, because it's not like the whole market is selling off and everybody running for the exit door. So how do you think about something like this?
Yeah, thanks for having me back, Carol. I think at the end of the day, we're seeing the evolution of artificial intelligence and large language models. We're seeing what I would call sort of the gradual commoditization of artificial intelligence and, less compute power and, less GPU power, less electricity demand needed for a product that is 98% as good as the best product we have here in the United States. Is the story of the day. And obviously the hyperscalers are under a lot of pressure. As you mentioned at the break there, Nvidia is down 17-18%, Broadcom is down 17-18%, because they were the sort of hyped up company, so to speak, that were going to be the beneficiaries of this AI demand. You have data center stocks, which are very much part of that ecosystem, down big today. You have sort of the cooling stocks that cool the data centers down big today. But then you have other parts of the technology landscape today that are interestingly doing quite well. Yeah. And they seem to be almost like the beneficiaries of this commoditization of AI, as I'm calling it. which is to say, if you remember just a month or two or even a week ago, it was how much is Facebook, how much are or Meta, how much are these other companies spending on CapEx, and essentially that's to purchase the hyperscalers, the Nvidia chips, the Broadcom chips, and now that narrative is changing, and so you have software companies like Salesforce and Workday and ServiceNow that are huge beneficiaries of the implementation of AI into their software packages. But now they're thinking this morning, well, I guess maybe this will cost us less, and those stocks are in the green today.
Yeah, that's interesting to hear. I'm wondering if you're using this as an opportunity to buy or sell. Are you changing asset allocation at all within your portfolios?
Well, not doing a lot today, but happily, it's challenge. If you're an active manager, Nvidia is 15% of the Russell 1000 technology index. If it's 6% of the S&P 500. So even if you're an active manager, and even if you own these names that aren't doing well today, you have to own more than if your benchmark's the S&P, you have to own more than 6% of Nvidia in the S&P to say, well, that's a real active bet, right? So unless you're underweighted, and so. No, we feel reasonably good today. We have good broad diversification. I think there's been a lot of concentration in this market. We saw that in 2024, Tim, where if you look at the S&P 500, almost 65% of the returns last year came from 10 names, of which many are the names we're talking about right now. And to the extent that there's a broadening out of the market advancement in 2025, if we are up on the year, we welcome that. You look at the equal weight S&P 500 today; it's only down 0.25% today. It's quite telling.
So, forgive me. Are you buying? Would you be buying an Nvidia? Would you buy a Broadcom because they've all of a sudden been whacked in a big way? If you still believe in them fundamentally, and I'm not sure if you do, or I'm just curious.
Yeah, we believe in growth opportunities within the technology segment. We would also argue that there has been a significant amount of passive dollars flooding into these names, driving them. If you look at the top 7 names of the S&P 500, they're trading over 30 times forward multiples. You look at the bottom 493 names, trading at 17 times. So right. Do we think they're quality companies? Yes. Do we think that some of them are not trading at necessarily the most attractive price point? Yes, and we think we can be in the affirmative on both, but we do think, too, that that doesn't necessarily mean over the long run that dollars are going to be accruing significantly away from these hyperscalers. But there's broad opportunity across technology. Even the utility landscape today was quite interesting, where this whole narrative around electricity demand, we've been hearing it for weeks and months. Look at Constellation Energy today. Yeah. That's the deal that Microsoft did, right? 3 Mile Island. That's down 20% today.
Right. Look at Vistra Corp.
Down 30% today. Look at the water utilities today that no one wanted to talk about last year. They're up 5, 6, 7% today. So it's really interesting, this rotation we're seeing.
So interesting rotation. Is it an investable interesting rotation?
Well, I mean, just look at multiples. I mean, we haven't permitted a nuclear build out since the 1970s. The market's acting as though we're going to have a dozen nuclear build outs contracted in 2025. It seems highly unlikely. I mean, we do think that we're going to have less regulation, but even the announcement at the White House last week was quite interesting, where if you looked at the $100 billion spend a year for 4 years, actually more than that, it's $500 billion over 4 years that was announced to build out AI infrastructure. That timing looks a little off right now, but to build out AI infrastructure, the amount of electricity demand for those data centers would be about 1.7 gigawatts per year based on the dollar spend that they're talking about. That's about actually it's 2.7, excuse me. That's almost 3 nuclear power plants a year just for that project. So that we were getting, I think, over our skis in the marketplace to some extent.
Aaron, how much
over a short time?
Okay, if we were getting over our skis now, to continue the metaphor, where are we on the slope?
Well, I think there are plenty of opportunities in the market. As I mentioned, if you look at forward multiples outside of this sort of, hyper-focused area of technology, We've even in utilities, as I mentioned, the water utilities they have nice ROE growth. They're trading at reasonable multiples. You look at the industrial segment of the market, we're seeing a lot of opportunity across the board there. If you look at certain segments of the financials, we think M&A activity is going to accelerate this year. Mm-hmm. Private equity funds have, in many cases, reached the end of their life in terms of the limited partnership duration of 10 years or more. And so we think that these companies are going to need to be either brought into the public market or sold back into the private market this year. Huge opportunities for banks, advisory firms, companies that work on valuations of private equity.
Okay.
So plenty of opportunity there too.
All right. Aaron, thanks so much. Aaron Kennon, he is co-founder and CEO at Clear Harbor Asset Management, joining us from Stamford, Connecticut.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.